What's up, everybody? Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Happy Monday, everybody, and a very happy Year of the Tiger. First up, let's discuss the Chinese economy, and this time we're going to look at two important metrics when we discuss the economy: consumption and manufacturing. Now, for consumption, let's dive into tourism spending. The reason I like to look at tourism is because I believe spending in tourism is, one, a great proxy for retail spending in the economy generally, and two, an excellent indication of consumer confidence. Because when people are hesitant to spend money, it's typically holidays that they cut first. Now, some of you may be saying, Tony, there are small-scale outbreaks across the country. People are going to travel less for that reason. Well, actually, the data in the past and the current data shows that people are less likely to travel outside their province, but they will still travel within their province. And also, because of the pandemic, people are not traveling overseas, which means the market for domestic travel is potentially bigger due to the entrance of these wealthier households who would have traveled overseas if not for the pandemic. We need to keep an eye on consumer confidence and consumption generally in the Chinese economy, because we know, one, in order to rebalance the economy to a more sustainable growth model, consumption needs to increase, especially relative to other areas like investment. Two, consumption has not returned to pre-pandemic levels. And three, the government has identified weak consumption as one of the major headwinds the economy is facing. Okay, now let's look at tourism and the raw data that we have from today. And surprise, surprise, things are not very optimistic. According to data published on Monday by the Ministry of Culture and Tourism, in 2021, revenue from domestic tourism rose 31% to 2.92 trillion RMB, about $500 million. However, this figure was only 51% of that in 2019, pre-pandemic, and the second lowest since 2013. According to the official data, total domestic trips in 2021 are still a whopping 46% lower than in 2019 at 3.2 billion trips. Now let's look a little bit closer. According to the data from state-run think tank, the China Tourism Academy, two trends were seen in 2021. One, travelers looked to have shorter trips in 2021, approximately 33% shorter on average over the last year, and households were less willing to undertake cross-province tours. So we can see that tourism is happening, but spending is still at half the pre-pandemic levels, a strong sign of weaker household confidence. Now let's move on to the next part and look at manufacturing, because we also have fresh manufacturing data for January. Chinese financial media outlet Caixin Media reports that activity in China's manufacturing sector shrank in January for the second time in 3 months. Quote, as COVID-19 flare-ups in the country restricted production and demand of manufactured goods. End quote. Caixin itself collects data for its Caixin China General Manufacturing Purchasing Managers Index, PMI, which it claims gives a snapshot of the country's manufacturing sector. In the past, this particular index has indeed been one of the more reliable ones within the mainland. In January, the PMI index fell to 49.1 in January, and remember, a number below 50 signals a contraction in activity. This reading in January is the lowest since February 2020 during the Wuhan and national lockdowns. So what is going on? Well, according to Caixin's own senior economist in their so-called Caixin Insight Group, Wang Zhe, we are seeing the impact of sporadic lockdowns due primarily to Beijing's strict zero cases policy. Quote, from December to January, the resurgence of COVID-19 in several regions, including Hainan and Beijing, forced local governments to tighten epidemic control measures, which restricted production, transportation, and sales of manufactured goods. It became more evident that China's economy is straining under the triple pressure of contracting demand, supply shocks, and weakening expectations. end quote. That final line is a politically correct way of expressing concern about the economy in China today. Economists need to be careful when they make critiques of public policy. Cai Xin also reported that in January, new export orders fell to their lowest levels since May 2020, quote, marking the 6th straight month for a contraction, end quote. And also, according to the survey data, quote, employment in the manufacturing sector declined in January, with the rate of jobs shredding the quickest since April 2020. End quote. These are all, of course, very concerning trends, but we should not be surprised by them. For months, as Beijing has pursued its zero-cases policy, economists have warned that the economy would suffer. Now, speaking of Beijing's zero-cases policy, this week, on the eve of both the Winter Olympics and the Year of the Tiger, we continue to see stubborn, small outbreaks across the country, including in and around the sensitive city of Beijing. Now, because it is a very sensitive time, official numbers are especially unreliable currently, but at the minimum we have some idea of which regions are being impacted by cases and which regions are implementing restrictions to slow the spread of the virus. The National Health Commission reported today, Monday, that China found 58 new COVID-19 cases yesterday on Sunday, down from 81 the day before on Saturday. Again, these are official numbers. 40 of the new cases were local infections, with 24 from the city of Hangzhou, home to Alibaba, and about an hour from Shanghai. 11 from the northern city of Tianjin, which has been dealing with cases for almost a month, and 3 official cases in the capital, Beijing. In recent days, cases have also been discovered in Shanxi, Hebei, and Hainan. Okay, last up, let's continue with our daily coverage of Evergrande and China's housing crisis. Quickly, if you're enjoying the episode, don't forget to hit the like button. It's the only way this video can be shown to new people. And if you're watching this for the first time, you're getting some value from the episode, maybe consider subscribing, hit that bell notification, and you'll have the most up-to-date analysis when I release these every day. Okay, let's move on. Last week we discussed Oaktree Capital seizing Evergrande's Palace of Versailles-like project, Project Castle in Hong Kong. This is because China Evergrande Group used the massive project in Hong Kong as collateral for a loan from Oaktree Capital, a loan to restructure part of the company's massive debt. This is Evergrande's massive debt. When Evergrande failed to meet its obligations under the loan agreement, Oaktree Capital appointed receivers for the asset last Wednesday. According to reports in August last year, Evergrande had already invested over $1 billion into the project. The farmland that's going to be used for the project had originally been purchased back in 2019 for $500 million. Now, this Project Castle, seized by Oaktree last week in the Hong Kong Special Administrative Region, should not be confused with the seizure of Project Venice near Shanghai, which we discussed on China Update yesterday. That was also by Oaktree. So in the last week, Oaktree has seized or moved to seize projects from Evergrande, one in Hong Kong. This is what we're talking about here now. This is Project Castle. The other in the mainland, which is more incredible actually, frankly, which is near Shanghai, Jiangsu, I believe, near Shanghai. That's part of Project Venice. These are separate projects that have both been seized by Oaktree. We have more news about this development, the Hong Kong seizure. According to a filing with the Hong Kong Stock Exchange published yesterday, Evergrande said it was, quote, seeking legal advice to protect the legal rights of the company, end quote. The crisis company also expressed in the same filing with the Hong Kong Stock Exchange yesterday, quote, at the same time, the company is in active discussions with the lender on resolving this matter with a view of reaching a resolution, end quote. Oaktree Capital recently rejected Evergrande's proposed debt restructuring plan, and based on its moves within the mainland over the last few days, it suggests that Oaktree is in no mood to go through any more negotiations. Now, these confiscations or these seizures are big deals because these were large assets that Evergrande has, and it's going to make it even more difficult for it to meet its international and domestic debt obligations if it's losing a lot of these assets through these types of seizures. Now, I just wanted to spend the last few minutes of this video talking about Ocean Flower Island. This, of course, is the artificial island that was constructed in Danzhou in Hainan, which was in the news in December because there were 39 residential buildings that local government ordered Evergrande to demolish. This was a very popular news story. A lot of you guys have asked me over the last month, what is the situation with these buildings, this artificial island? It's actually been one of the most common questions I've had. Over the last few days, a lot more information has come out. There have been several reports, there have been leaks, and there was a deep dive from Reuters just today. So we have a little bit more information on the situation with Ocean Flower Island and these artificial buildings, whether they've been demolished yet, and that sort of information. So let's just finish with this information. For anyone who's not interested in this particular project, even though I do think it is important to understanding the Evergrande crisis and how other property developers may be treated by local governments over the next few months. If you're not interested in this story, this will be the last one we cover, so maybe just end the video here, I guess. But for everyone else, let's dive in. Ocean Flower Island was officially open last year and at the time represented the world's largest artificial resort island under development with a price tag of around $13 billion US. Inspired by Dubai's artificial islands, Ocean Flower Island consists of theme parks, 5-star hotels, Michelin-starred restaurants, malls, shopping areas, spas, and residential homes. Now, the Reuters story that came out today perfectly articulates the change in fortune for Evergrande that Evergrande has experienced since those more promising days last year. Quote, "Now Evergrande is in default to global bondholders. The former Communist Party secretary of the small Hainan island city where Ocean Flower Island was built is serving a life sentence for bribery, and officials in Danzhou City have ordered 39 of the project's towers, roughly 3,900 of the island's 65,000 homes, to be demolished over environmental and construction violations." End quote. The demolition of part of the 2,000-acre flower-shaped project has not happened yet, and if Evergrande cannot prevent it, it would be yet another blow for the company. Outside of the 39 under-construction residential buildings, Evergrande has said the rest of the project would be unaffected. Based on government documents as well as leaks to media, neither of which are particularly reliable, frankly, the project seems to have breached environmental and zoning regulations during nearly a decade of development. Quote, "Eventually drawing scrutiny from regulatory authorities," end quote. Indeed, we can see as early as 2017 the Danzhou government hitting Evergrande with environmental penalties due to unlawfully reclaiming land from the sea. Reuters reports that a Hainan provincial government document issued in early 2019, posted on the government's website, showed Danzhou had levied $34 million worth of fines against the project. These fines were paid according to the document. Now, ultimately, what does this all mean for property developers? Well, Li Gen, CEO of Beijing BG Capital, speaking to journalists this week, observed that what is happening in Hainan suggests local governments are tightening their grip on irregularities of all property developers generally. This is the same observation that I made back in December when we talked about this demolition order that was put on Evergrande for these properties. As such, we will likely see more cases like Ocean Flower Island in the future. Hey guys, I'd love to hear what you thought about some of the updates we covered in today's episode, so throw your comments below. Always love hearing from you. Thank you for watching. I'll see you next time.